Hello, welcome to July, first Thursday of the month, actually first day of the month, and it's our July Cup of Joe. I'm Mike Carrazzo, Content Manager here at Ryerson, and I'm joined as always by Nick Webb, our Director of Risk Management, Commodities Hedging, for another view into the marketplace. Nick, how's it going?
Doing really well, and it looks like based on our technological issues we were having, apologies to everybody, I'm actually going to be Mike Carrazzo this month, so it's going to be real exciting.
No complaints here. You're going to make me sound a heck of a lot smarter than I normally am, so I'll take it. So, market demand remains high. Steel prices remain high. Something's got to give, right? You're going to give us some good news today. Is that right?
I think I'm going to give, I've got a lot of information to give. We've got a lot to talk about. I think we're starting to see some, interesting dichotomy between the various markets, some improving, some potentially getting a little worse. And I think we'll have plenty to talk about, hopefully plenty to answer within the Q&A section, but no shortage of interesting things going on within the wild world of commodities right now.
Yeah, and while you get the presentation queued up, glad you mentioned that, the Q&A. As always, there's a Q&A tab at the bottom of your screen. Please submit questions along the way. We'll make time at the end to get through as many of those questions as we can. And just a reminder for everybody that these are being recorded. So if you missed a portion of it, or for some reason you weren't unable to attend, it'll be on YouTube early next week. And it'll also have little snippets of it on Ryerson.com next week. So stay tuned for that.
Excellent. And so before we hop into my portion, I actually want to kick it back over to you, other Mike, to give kind of a quick shameless plug, if you don't mind.
Yeah, thanks for that, Nick. So we thought kind of give it back to the audience here, your chance to kind of weigh in on how the market's going. Every year, twice annually, Ryerson does this customer survey. We call it the metal perspective. We look into macro and micro trends that are impacting the marketplace. We ask things like how the administration is impacting your business thus far. What parties are biggest at play for what's going on in the marketplace right now. Level of concern, optimism. We really want to hear your thoughts. I'm going to put the link down in the chat for everyone. It's 7 quick questions, so it should only take about 3 or 4 minutes. We'd really appreciate it. And then when we send out the recap, the link will also be in that as well. We're going to keep that survey open through the end of next week, and you'll get an advanced copy of the results. So be great if you can participate. Thank you for allowing me to plug the metal perspective here. So back to you, Nick.
Awesome. Really appreciate it. And excited to hear the results of that one as well. I think it's almost like a mini ISM index, if you will. That being said, before we hop into the information, many of you have already seen this before. You know that this is not information, or this is not investment advice. Do your own research, things like that. Have to cover these things for the legal reasons, but let's go ahead and hop into the slides. So I'm pulling a little bit of a fast one on you, Mike. This was not a slide that we actually talked about in our run through, but it came out just today. It's hot off the presses. This is the ISM, so the Institute of Supply Management. And I just got a notification my internet's a little rough, so I apologize if I'm skipping around. But that being said, the data was fairly interesting for a couple of reasons. I noted a few arrows over on the left-hand side. The first thing is demand is strong. The index came in at 60.3, no doubt about it, that is growth. But what's interesting is that it actually came in at a slightly lower clip than expectations, and it came in at a slightly lower clip than last month. So what does that mean? We're still seeing growth here within the United States manufacturing market, but it's slower growth. So that's actually being corroborated within China. China also saw a growth figure of 51.3. That was a little light of expectations. And a little lower than last month, which would have been 52. So there is a little bit of a creeping tune to the market of slowing growth. The rate of growth is slowing. When you dig into some of these other items that I've highlighted over on our left-hand side, I think if you were to take anything from this presentation, I think this slide actually does a really good job of summarizing how we're seeing the market and how the manufacturing community is seeing the market. A couple things that I want to point out. Employment, we talked about the employment picture for the last couple months. Crazy enough, the employment picture is not getting any better. If anything, the ISM survey is actually suggesting it's getting worse. So it's actually gone into contraction territory on a month-over-month basis. So that's a new data point. You can see over on the right-hand side, that's actually the first time that that's happened on this particular trend. Additionally, I think it's worth noting that inventories are actually starting to increase. So could that be a sign we're beginning to see some of these markets actually normalize and balance out a little bit? This is something that we've seen now for 2 months running. And I would say that's corroborated with what I see here within internally at Ryerson, that very, very slowly, it does feel like supply is catching up to the demand conditions. Finally, we're not seeing it as much within price. And actually, when we look at the next item here, you look at prices, this is a staggering figure. It's the highest figure since, I think it's 1978 or 79. The ISM prices data came in at 92. That's up from 88 last month. So just staggeringly high price inflation expectations being built into the manufacturing community. Now that's been a trend that we've been seeing for the last year, but it's just getting worse and worse. And we'll dive into some of the specific commodities where we're seeing some of that, and even some of the commodities where we're seeing opposing trends. And then lastly, imports. I want to know, I always get the question about whether or not we're seeing imports going up. We are. I think it looks like the industry is as well. That's a pretty big jump. You're seeing, May's index was at 54. It's now at 61. That's a pretty big increase in the rate of imports. So this is kind of a good summary to set the stage on what we're going to dive into here in the next several slides. But let's go ahead and hop into it. The first things first. This is the chart of the Bloomberg metals. I think the Bloomberg Commodities Metals Subindex, and you can see ever so slightly we're starting to see a little bit of softness. Now it's at very, very high levels on a 5-year basis, but there has been a little bit of retracement in some of the metals we watch, namely copper. Copper is actually off by about 12 to 15% in the last 30 to 45 days. And copper tends to be a pretty big key driver of a lot of manufacturing indices. So that's one aspect that we are seeing. But, is this going to be a sign of more weakness to come? We don't know yet. And there are going to be some other metals we're going to talk about that are going the opposite way, namely steel. Carbon steel, while we continue to try and, figure out where the top's going to be, we continue to hit record high prices. And here on the front month futures contract, so this is not the CRU, this is the front month futures contract. Basically, the expectation of where the CRU is going to be for the month of July, it's up at $1,810. Now, I've overlaid that with something that I the price of lumber. Well, a couple reasons. One is they both generally tend to go into the infrastructure of North America. Maybe slightly different applications, one being maybe a little more automotive, heavy durable good type applications. But nonetheless, lumber is a key ingredient or key component going into a lot of these manufacturing end markets as well. Very heavy linkages to the residential economy, the construction economy, as steel would be too. And what's interesting is you don't even have to change the axis on this chart. A year ago, we started out right around $400 on each of these markets. Over the last 12 months, we peaked out where we got up to a level of around $1,700 to $1,800 per unit on each of these indices. Well, fast forward to where we are now, we've got steel that's still going up and going to record highs. Lumber, on the other hand, is actually cratering. In the last 45 to 60 days, it's come off by more than 50%, and we're now down at $692. Why do I bring this up? I only bring this up because these tend to be cyclical markets, and at some point, these markets are going to turn. At some point, prices are going to go so high that supply comes online, or you get demand destruction, which I think is some of what we've seen within the lumber markets, and you see the other side of these parabolic moves. Now, I'm not here to say that the marketplace or the fundamentals are identical within steel as they are with lumber. They certainly are not. I think there are some factors that are allowing steel to play out longer and go higher than what we saw within lumber. But I at least want to throw out the warning sign or the wet blanket, call me wet blanket Webb if you'd like, Mike, that when this thing starts to soften, it can come fast. And that's not to say it will, it's just that it can. And commodity markets can whipsaw pretty quickly. So take that for what it's worth. I think it's an interesting data point. Why?
Sorry, that's a huge split right there. You mind going back for a second? I mean, if we just
absolutely.
if we look at that chart you showed, I'd call it, 2 months ago when we started Cup of Joe, those were neck and neck. That's a huge split and I'm sure you're going to get into reasons why, but I mean, you just look at that and does it provide some hope, or what do you think?
It could. No, I'm not a lumber expert or a timber expert, so I can't say exactly what the specific dynamics are within lumber are. But generally speaking, I think you can talk to the notion that at some point prices can go so high that they actually become demand destructive, or they incentivize supply, or both. And I think in the case of this chart that I'm following up with, I think gives a credence as to why we're seeing that within the lumber market. We looked at this briefly, or similar chart briefly last month. This is from the University of Michigan consumer sentiment data. So this is how good or how optimistic buyers feel with regards to, in this case, household durable products, houses, and vehicles. So again, not all industries within steel and lumber apply to these, but there are some similarities that durables, houses, and vehicles do consume both products to some capacity. And it's like a razor's edge how sharp the decline has been just in the most recent data points, how quickly, as we assess this chart, how quickly buyers have essentially gone negative or pessimistic about the marketplace. So whether or not that's because prices are going too high, or whether or not that's just because there's not enough supply of goods, for whatever reason, buyers are not feeling very good about the marketplace for houses, durables, and vehicles. Now, I think that that's actually fed into the weaker lumber prices, because I personally think that we got into a situation where house prices were on such a tear, supply was so tight, that playing the game of trying to outbid your neighbor with cash became too frustrating. And I think people went to the sidelines. And when people go to the sidelines, demand can shut off pretty quickly. Again, I'm not saying that is what will happen within steel or many of these other manufacturing markets, but I think it's at least something we want to be cognizant of, because these trends can flip on their head very, very quickly. And when they do, lumber at least is an anecdote or an example of how quickly that price can come off. So is there a price to which steel can go to where an architectural project turns offline or says, we're not going to do this anymore, we're going to wait for a year or 2 years? I think there is a price. I don't know exactly what that is. It's probably different from consumer to consumer, but I think it's definitely something we want to be cognizant of.
Nick, do you mind if I jump in? We got a question from the audience. I think really applies here while we're on the topic. Say lumber prices down due to supply from Canada and shipping to the U.S. again post pandemic. Is there any truth to that the supply's kind of back coming from Canada, or maybe it was cut off before?
I think whether the supplies are coming from Canada and sort of, just paying the tariff that's in place and bringing it in that way, or whether or not it's just domestic supply. I mean, I think I made the joke in the last month's call where there's no shortage of trees. I mean, we have plenty of trees. And in the same regard, we have plenty of steelmaking capacity in the world. That's not why we had and are having record high prices in these things. It's just we're not getting the right product to the right place at the right time. And I know that's an oversimplification. But yeah, I do think that there's an element of Canadian lumber and domestic lumber coming in to meet the high prices with additional supply. So, there's always that saying, nothing cures high prices like high prices. And that's going to be truer than ever in a lot of these metals markets we're in.
And as one of our panelists points out, we can't blame Canada. It's Canada Day, so we can't do that.
We won't blame Canada the way South Park wants us to. We talked last month about the perking up of crude oil, and we didn't have any slides on it, but I did want to revisit it because it does have some direct implications to really all things that we do within the manufacturing world, but even more specifically within the carbon plate and carbon long world. Crude oil, as I mentioned last month, looked like it was starting to join the party of a little bit of a short squeeze. And what I mean by that is demand coming online at a faster clip than what supply is. And it continues to be the case that supply, whether it's OPEC or just here domestically, is relatively slow to come back online. And in some ways, I think it's purposeful. OPEC met over the last 24, 48 hours, and they are going to bring additional production online, but it's less than what was expected. So, we've got this interesting dynamic that we've already seen play out in steel and lumber and some other markets, whereby, automotive travel demand is quite strong for summer vacation. TSA checkpoint data for, as a representation for, airline travel is coming back pretty close to pre-COVID levels, and that's even before you have a whole lot of business travel. I do truly think that there's a little bit of a mismatch between the rate of increase in demand and the rate of increase of the supply response. And if that sounds familiar, it should, because we've seen it play out in a lot of other commodities. We're now seeing crude oil at $75 a barrel. There are a lot of producers who can make a lot of money at those types of prices, but they're not yet coming back online. So are we going to see a squeeze and continue to see crude oil go higher? We may, and if it does, that's just going to add one more spigot to the demand side of things for carbon plate, carbon long products, and probably metals in general. But it's also going to increase freight rates to get product moved around the country as well. So I want to make sure we revisit that, because it does look like this trend is continuing to play out. We mentioned it very briefly on the first slide with the ISM. I was wrong last month. I was of the opinion we were going to start to see employment data improve. We aren't yet. I do really want to understand the question of when do we finally start to see supply of labor loosen up, or in other words, people come back to work. I think Ryerson is a very good example of this. We're trying to hire a lot of employees right now, and it's very difficult. It looks like it's becoming more and more expensive to do so. You look at a lot of the banks right now, the banks are talking about doing 15, 20, 25% wage increases to try and get people to either stay with them or come back to the office. This is going to be a very interesting one, because we're not seeing the data play out as fast as I thought we would. I thought when you started to remove some of the federal assistance for the labor issues, that you'd start to see this snap back in a quicker fashion, and we aren't yet. So this could be something that maybe we have to wait till September, October, when kids go back to school, companies start mandating people get back to work, that we finally start to see this improve. But again, I mean, this is playing out longer than I thought it would. So this is a pretty ugly recovery in terms of labor force participation rate back in the economy. So unfortunately, that looks like it's going to keep some of the bottlenecks, at least some of them, still in place for a little longer. And then lastly, this is one that we haven't discussed really at length in the past, but I wanted to at least throw it out there because the chart is absolutely staggering. This is the price to get a container for the shipping route from Shanghai to Los Angeles. If you ran any shipping channel, whether it's Shanghai to US or Europe to US, the trend is going to look generally the same. You're basically looking at like a 7 to 8 fold type increase over the last 15 to 18 months on the price to get containers. So there's been a lack of production. There's been excess demand of containers. There's an issue of containers being in the wrong places. Just a lot of inefficiencies causing prices to go absolutely parabolic. And I've got a number of friends who are in the supply chain side of things, and obtaining a container is it's like finding gold under your pillow. It's a difficult thing these days, and it's a rarity, and it's lovely when you can finally find them, but it's causing inefficiencies within the supply chain still, and it's getting worse.
So Nick, to put that into perspective, right, you showed earlier with the divergence between the U.S. price of metal and China. That's a chart we go over pretty well, and there's a difference there. But like we say time and time again, even if you are able to get that, you look at a chart like this just to bring it into the country and then get it around the country. The cost of that could almost get you where domestic prices.
It gets you close. It gets you close. I mean, it depends on the metal, depends on the situation, it depends on the shipping route. But yeah, no, I think it's a great segue into the carbon world where those spreads are glaring. I mean, they're the biggest we've ever seen in history, and continuing to grow. Again, I'm using the hot roll futures contract in this case, and so it's not the CRU, but it's basically representative of the CRU. And when you compare that to European prices, it's a $500 to $600 spread. That's an FOB local price, basically. You look at the price versus China. China's less than half of what pricing is for United States steel. So yeah, freight does close that gap a bit, but in the case of Chinese steel, if there weren't tariffs, that it doesn't matter what the freight rate is, you can bring it in for cheaper. Unfortunately, we have that freight, or the tariff rate rather, that's several $100%. So it makes that somewhat unattainable. But my perspective, at some point in time, this gap needs to close. I mean, we've mentioned it in prior calls. China makes up 50 to 60% of the world's production and demand of carbon steel. They very much so weigh on the global price of steel. whether or not we can buy it direct or whether or not it seeps into other markets like Vietnam, Taiwan, places like that, and then eventually comes to the United States. The gap is glaring enough that this arbitrage, this gap between the two prices needs to close up. And I think it's coming. I still think it's coming. I think, when we look at carbon, I think I've got a little bit of good news to suggest that supply is beginning to hit that transitionary period where I think it's getting caught up. We'll run through a little bit of very high level, rough math to run through the supply demand situation right now. This is the first aspect of it, which I think is very encouraging. It should be very encouraging for all of us to see, which is finally U.S. production data is getting back to pre-COVID levels. I've shown the chart in the white line, which is capacity utilization as a percentage. And then I'm showing the blue line as well, because there's some belief in the marketplace that some of why we're seeing the percentage go up is because they changed the way the calculation works. They, in other words, they took some of the production assets offline because they've been curtailed. So I wanted to show the actual tonnage production data as well. No matter which way you split it, they're pretty darn close to one another. And when you compare that back to 2019, 2020, we're getting pretty darn close back to pre-COVID production levels. So that's one aspect of it, which I think it should be seen as very good news, that finally some of those, past dues, things like that, are getting caught up ever so slightly. We're not seeing that yet feed through into better pricing or lower pricing. CRU this week was still up 35, I think it was $37, but it's still making big jumps on a week over week basis. But it does look like we're in the early innings of supply normalizing. In addition to that, and there's a lot of data here in this chart, but I really want to focus on is the bottom right corner that I've circled in red, which is if you look at import data on an annualized basis, comparing this year, basically the first 5 months of this year to 2020, we're up on an annualized basis by about 3 million tons. So sprinkle that on top of the fact that you've got domestic production actually getting back to pre-COVID levels. That's a good sign. That's a sign that we're getting back into a more normalized supply-demand condition. Offsetting that, however, we have to talk about the fact that there are outages that we're in the middle of, and there are outages that are coming. Some of those accidental, some of those are planned. Over the last several days, we've seen Steel Dynamics in Columbus. They had a fire that took them offline for about 10 to 14 days. But in addition to that, there are a lot of line items here. Each one of these is a different mill, different location, a different duration. But really what I want to hone in on, again, the bottom right corner, these outages between the balance of the year are totaling about 1.2, 1.3 million tons of production capacity. And if we're trying to be fair to the entire equation that we're running through, if you were to annualize that annualized number is going to be closer to about 2 million. So it's not all good news. Again, you're basically talking about domestic production getting pretty close to pre-COVID levels. You're talking about imports being about 3 million tons above, which is good news. And then annualized, we're talking about outages coming out to the tune of about 2 million tons. So net, I'd say we're probably on an apparent supply side of things. We're probably up a couple percent at the current run rate that we're going at, which should help to bring things a little back under control here in the coming months. Did I run through all of that okay, Mike?
Yeah, absolutely. And I think you struck a chord with the audience. We're getting a lot of questions about these slides. Do you mind backing up one slide for us? Two slides, I guess it would be now, asking particularly about the blue line versus the white line in this carbon. That looks like the capacity utilization. So the white line is representing what again?
Yeah, so the white line is going to be the percentage utilization. So in other words, if you took an assumption of all of the assets within America that can produce, that are operating and can produce, versus what actually are producing, that's how you get the percentage. So you'd say what percentage of the tons going out the door as a percentage of the overall total. That's what the percentage utilization represents. Now, so what we understand has happened over the last couple of weeks is that they changed the calculation by actually pulling a couple of the mills out of the equation for the denominator of this percentage equation, because they're permanently offline. They've basically been deemed out of the system. They're no longer part of the equation. And that's why we're seeing the percentage spike, maybe at a disproportionate rate than what the actual production tonnage is. That's why I wanted to include both, because I don't want to give the sense that production has all of a sudden spiked massively the way the percentage line has. It's still coming up, and it's generally still going in the same direction. But I wanted to be fair by just showing the tonnage, because really at the end of the day, tonnage is all that matters, from a supply standpoint.
Absolutely, absolutely. And so, and I think you hit on this in 2 slides down, but if you were asking about, will these plant closures worsen the market, in our mills adding shifts, or is controlled order entry calming down? So I think it's kind of,
I can tell you from a mill perspective, the mill salespeople are absolutely out on the line. They're on the phone lines. They're meeting with customers. They're telling every one of their customers about the closures. So there's certainly an effort to make sure that all service centers, all end customers know that these closures are coming, because I think it's a way to potentially dampen, any kind of downside impact. It definitely provides support to the bullish narrative. So is it real? Absolutely, it's real. I mean, those are real tons that are going to be coming offline. The one aspect that I didn't touch on within this quick equation that we did was there are additional tons that are coming online from new mills, and that's not contemplated within that quick bit of math that I just did. So yeah, 1.2 to 1.3 million tons coming out over the next 6 months. Yeah, that's a big deal. It's also a big deal that, we've got a large number of tons coming starting basically now until the end of the year from a few different mills here within North America that's also going to offset that. So both matter. Both matter, absolutely.
Great. Thank you.
Yeah, for sure. And we've talked, you could assume based on the commentary we've already provided that the charts would look like this, but this is the futures curve or futures curves a month ago, a week ago, and today. And it's just onward and upward. There's still an expectation that at some point we're going to come off, and potentially come off at a fairly rapid rate. But every single month we move forward, the CRU is higher, futures move higher. The shape of the curve generally is still the same. So not a whole lot new here. It just continues to be more of the same, and it continues to be wrong, admittedly. But the expectation is that this thing is going to hit an inflection point once supply does actually catch up with demand. And I will say, I do think we are in the early innings of supply actually getting back to that point of normalizing the supply demand conditions. Now, we haven't had a ton to talk about of note or really materiality within the aluminum world, but I think we've got something that's going to be very interesting to a lot of our listeners right now. In the last week, and this should sound fairly similar to maybe 2017, 2018 type commentary, Russia announced in the last week that they are going to implement, or they're looking to implement, for the August through December of 2021 time period, an export tax of 15% plus $250 to $54 per metric ton. Russia, for those who don't know, represents 20% of the world's aluminum production. So they're big players. When they sneeze, the rest of the world hears it. There's a belief out in the marketplace that this could have a very swift and robust impact to Midwest premiums and premiums of ingot all around the world. Here within North America, we're most predominantly interested in the Midwest premium. And there are some forecasts out there that are suggesting that if this tariff were to go into place, which there's still risk that it may not, but if it were to fully go into place, and if those exporters fully try and pass on that tax to its consumers, we could see Midwest premiums go above 50 cents. The expectation is that it could go as high as 57 cents per pound on just the Midwest premium. That, for those who don't know, we're already at record highs right around 28 cents. That would basically be a doubling of a record price to that new price. Now, there are a lot of questions about whether or not this is going to come to fruition. Ultimately, Russia is trying to put a lid on their own inflation that they're seeing domestically. They're trying to say, we're seeing prices going to the moon. Let's do everything we can to actually stymie exports of product that we need. Let's put a tax in place. And if people still want to buy it, then they can, and the government collects its money. There are questions about one, whether or not it actually gets implemented, which I think is why we haven't seen as robust of a move in price as one might think you would. And I think the other aspect is there is a belief that the exporters might actually eat a portion of that tax. So that's really the million-dollar question, is if the tax does go into place, how much of that pass-through is going to occur to the end consumer? If it's all of it, then we could see pretty robust, swift moves in Midwest premiums higher. If the exporters say, you know what, we can't pass this through, we'll wreck the export market, then you could actually see Midwest premiums relatively mundane. All things being equal, a lot of the analysis I've seen suggests that we shouldn't see too much of an impact to the London Metal Exchange price. That's kind of a net neutral impact to the LME. That really all of this impact is going to be centered around Midwest premiums. And when we look at the same data that we did with steel on the futures basis, so a month ago, a week ago, and then today, Midwest premiums have spiked up. It's not massive. It's about 10%, so 2 to 3 cents basically. It's a far cry from that 26 to 27 type cent move that some of the forecasters, talking heads, analysts are talking about, but it has moved up. So it is worth noting. There has been some commentary that's basically saying some in the industry believe that the market is underestimating how big of an impact this could potentially be. If you look at just this futures market, they're saying it's going to be relatively muted. We will see. I don't have a great answer as to what policy, tax policy within Russia is going to be. But I do think it's definitely something we have to keep an eye on, because as we remember back in late 2017, 2018, I drew in this horizontal line because, no coincidence, London Metal Exchange prices are actually right back to those levels that we saw when the export ban was put in place against Russia. Basically, all the sanctions were put in place against Russia. You can see that when that happened, anytime you touch Russian aluminum, because they're such a big player, the gyrations and the volatility that exists in the market can be pretty robust. And I mean, at that point in time, you saw LME prices go from about 87 cents all the way up to $1.15, pretty much overnight. Now, it reversed course almost as quickly, but we could see some volatility here in the coming days, weeks, as this gets absorbed in the market, and as we get closer and closer to that August date, because as I mentioned, that's when the export tax is expected to go into effect. And then lastly, on the stainless side, we've talked a lot about how the nickel chart's really kind of just, it's ugly, it's just choppy. It continues to be the case. I drew in this channel. It's basically showing the choppiness by which we've been in the price of LME nickel for the last 2 to 3 months. It continues to trade extremely choppy. I still do not see any reason why we need to break out in a massive way. I'm not aware of any policy changes that need to occur that would really suggest that we're going to run out of nickel. It's still pretty plentiful in terms of supply demand availability. So not a whole lot to note there, but what I will say is one spot within the stainless world has perked up quite a bit. And actually, let me take a quick step back, because sometimes I do breeze over the idea that there isn't a whole lot going on within stainless or stainless surcharges. Make no mistake, within stainless finished markets, the market is still extremely tight. So even though we're not seeing a whole lot new within the commodity of nickel, or maybe even the commodity of chrome, the stainless market is still extremely tight. It's on allocation, and it looks like it's going to be that way for the balance of the year. So it's not to say that there aren't things going on within the stainless world. It just isn't going on within the commodity element as much. The exception to that, really in the last 30 to 60 days, though, is molybdenum. So molybdenum is a rare earth. It's used as a hardening agent within stainless steel. It does go into 316 stainless. So if you're not buying 316, you can turn off the channel right now. Don't actually. But if you're a buyer of 316, then I think it's absolutely something you want to be cognizant of, because the price in the last 60 days basically has almost doubled. It's gone from about $11 to $12 a pound all the way up to $18, $15. Why that matters? There's a lot of data here on this chart, but ultimately this is a model that we use internally here on this end, and pretty much assuming on a month over month basis we hold all other elements equal, except for maybe nickel. Nickel's up slightly. The impact to 316 for August surcharges relative to July surcharges, that molybdenum move is going to impact things to the tune of about 5 to 6 cents single-handedly. So it is material, it is impactful, but it is just going to be applicable to the price of 316 stainless. So something to be aware of. Again, why is molybdenum moving 50, 60, 70% in a couple weeks? It's the same thing we're seeing in every other market. And I don't mean to be too flippant about it, but I asked a lot of analysts, I said, well, what's going on with molybdenum? And they just said supply isn't ramping up at the rate at which demand is coming back online. So it's the same general story that we've been seeing over the last 12 to 15 months, where demand is just catching supply a little off guard, and that can cause some short-term pain. There's no reason to believe that it necessarily has to cause long-term pain. I think a lot of these markets are going to be cyclical. I think a lot of these things are generally bottlenecks and inefficiencies, but they're hitting different pockets at different times. I mean, we mentioned the fact that crude oil is just now starting to join the party. Lumber, on the other hand, is going the opposite way. There are a lot of agricultural markets going the opposite way. So I guess we're beginning to enter that period where whether or not inflation is transitory, it kind of depends on the market you're in. So if you're in steel, it looks like it's still here to stay. If you go to lumber, it's very transitory because we're back down 50%. So it's getting interesting. It's getting a little more complicated, but it's a market to market type dynamic. But that's what we've got for this month. And I hope we're able to answer a lot of Q&A, and hopefully that was good information for all of you out in the audience.
Yeah, and it looks like, as opposed to some of the previous ones, there's a lot more going on with aluminum and stainless. Not to say that there wasn't before, but I think there's some definite factors, right, that, like you bring up with Moly, and of course the sanctions going on with aluminum or potential, right? So I think there's a lot more going on than we've talked about in previous. So I'm glad we're getting into those a little bit. And yes, we did get through a lot of the Q&A throughout, so didn't mean to throw them in there for you, Nick, but handle them well. One that just kind of coming off the heels of that stainless, not sure if you can address this one or not, but audience members saying, I'm hearing rumors that OTK and NAS are considering moving away from 430 alloy production. Do you know any truth to that?
I have to plead the fifth and admit that because I'm not the one actually interfacing with NAS and OTK, I don't have intel specifically on the finished good. That being said, I can certainly follow up with our product managers and get a little clarity on that. I sincerely apologize. I'm more on the commodity side of things, not on the finished product.
Yep, absolutely. One that came in pretty early, and a topic that you've addressed a lot in the past few sessions has to do with the chip shortage in the automotive industry. And this question is, with the closing of several automotive plants in July, will that help supply chain issues with more access to materials?
Yeah, I mean, the semiconductor issue, similar to what we're seeing across the commodity landscape, it tends to be, based on what I'm reading, because I am a reservation holder for the Broncos, so I'm very attuned to this information because I want a vehicle at some point in the near future, but it's not coming. Talking intimately about the automotive sector, it does seem like it's producer to producer. It depends on which OEM you're talking about, because it seems like they've all struck different types of contracts with those semiconductor producers. 2 weeks ago, we were starting to hear that automotive was actually loosening up, and that the semiconductor issue was coming to a close. And then, just earlier this week, Ford then came out and said, well, for the month of July, we're actually going to be shutting down additional locations. So it's very much so a fluid situation. It doesn't seem to be pervasive across the entire OEM industry, but I think in pockets, there are certain contracts where they don't have enough allocated for them, and they're having to kind of change plans. And I know that's a little bit of a complicated answer and not a great answer, but it doesn't look like we're fully through the semiconductor issue across the board. There might be certain companies that are improving a little bit, but if to answer the question with regards to metal demand, if the semiconductor issue continues into the balance of this year or even into next year, and that continues to weigh on production of producing an automotive vehicle, yeah, that will affect demand without a doubt. Unfortunately, it also affects scrap supply. So you could see that end up being an increasing element to scrap availability and thus, or sorry, it would increase scrap prices, said shortly.
Makes sense. So I'll give you kind of a 2-for-1 here. So one of our audience members simply wants another look at the lumber slide. So maybe you can tee that one up while I
would
tee up
love
this
to.
question for you. This is, I think, a really insightful question. Is there anything we can do from a supply chain perspective to assist with driving down costs? I feel like it's always a weight game and completely out of our hands. So I guess the question from a customer perspective, anything we can do to help drive down costs?
In this environment, I would say it's much more difficult to have that negotiating leverage, and that's not true just of our customers. That's true for Ryerson when we try and negotiate with our own suppliers. It's not a buyer market. I mean, we don't have much leverage when we're all trying to get that next incremental pound of anything. It's not the ball's not really in our court. Are there small things that can be done? I don't have a great answer for this. No, I mean, with freight being as tight as it is, there aren't that many aspects where you can say this is a spot that we can really negotiate hard right now. I mean, whether you're looking at like coating extras for carbon, zinc is at elevated prices, so that's not really a negotiating chip. I mean, lumber, yeah, if you're getting something put on a pallet, yeah, absolutely. You can probably in the very near future go back to whoever that provider of pallets is and reference this chart and say, hey, the price of our wood should be much lower than where it was 2 months ago. That would be true. Outside of things like that, I mean, unfortunately, the negotiating chip really doesn't go to the buyers until you start to see the plateau, and thus far we haven't seen much of that plateau effect.
Absolutely. Here's another one, probably referencing one of the slides you had. In last month's discussion, there was a view that carbon would start to hit the downward trend in Q3. Do you have a view as to why we're seeing this move backwards?
I think that supply, I do still hold the belief that we're in the early innings of supply catching up to demand. I still hold that one to be true. But demand is holding firm. I mean, what we're not seeing is a whole lot of cancellation amongst big OEMs saying prices have gone too far, too fast. We don't want to buy anymore. We are not seeing, at least here at Ryerson, we're not seeing many customers saying, I'm ready to go to the sidelines and not buy. There's enough demand through the channel, through to the end customer, at least within the forecasts of many that we talk to, we're saying we're still needing metal at any price. Now, they don't love paying the prices that we're getting, but they're still buying it. So that example that I gave within lumber, whereby prices may have gone so high that people said, we don't want to build homes because we're too far over budget. I'm not hearing many instances within the metals world where that's the case just yet. There might be some instances within the architectural side of things where they've said we're far over budget. We got to go to the sidelines for 6 months or a year. But general OEM purchasing, people are still buying it. And admittedly, I mean, I do all of our hedging within Ryerson. We're still seeing customers looking to lock up prices at these types of futures levels, and not in small size. We're seeing big OEMs coming in and doing hedges. So I don't know what exactly that means, but it does mean that they're at least willing to lock into a price on a certain percentage of their material at these record high prices, right, wrong, or indifferent.
Sense. Yep. Here's another one. In your opinion, are renewables going to hold back the rebalancing of the market on carbon stainless due to the base material supply? So a question on renewables and the effect they'll
have. So my personal opinion, Nick Webb's personal opinion, it's an interesting one because over the last 4 months, I mean, China has gotten so much credibility, they've gotten so many headlines for China's going green, China's going to make cleaner steel, and yet China's producing more steel than they've ever produced in the history of the world, and they're doing it under their old ways. So I think some of it's smoke and mirrors. I think within the United States, there's a lot of EAF. I think you kind of have to separate out what is green. Within the steel world, it's not a clean industry, but are there cleaner ways to make metal? Absolutely. And I think the United States is very much so making a push towards being a more recycling friendly industry. We're going way more to EAF. That's not just for an environmental reason. That's also for nimbleness reason. You have the ability to turn on and off your mill in a quicker fashion than you do with a BOF. So I don't think it's just a green reason why it's happening. And do I think that other countries are going to shift towards EAF? I do. I think that as more and more scrap becomes available, I think it only makes sense that you continue to recycle that scrap, continue to be nimble, and utilize that effort. But in terms of us just flipping to carbon neutral footprint metal and steel over the next year to 2 years, I don't think that's happening. But I think it's a good trend to work towards that. And yeah, that'll play out. And that probably does lift on a longer term basis. That probably does lift the overall scrap price, carbon scrap, and probably, aluminum scrap, stainless scrap for the longer haul. But I don't think we have the ability overnight to flip anything to, carbon neutral metal production.
And last question here, it's simply a supply question. Does Europe, Middle East, Africa have more supply than North America right now?
I get it's kind of an interesting question because more supply, I guess it's all relative to their demand picture. I will say that the United States is far and away running the hottest of any of the markets in the world. So we are the net importer. So, just doing quick analysis of the global market, if we're able to import more metal, that means that there are excesses of metal elsewhere, or it's creating tightness situations elsewhere. Imports are ramping up. Metal is available, though it's tight and it's expensive, but we can get it here. But the United States is very much so driving the train right now, in a similar way that maybe in March of last year through August of last year, China was really driving the train into the recovery. The United States is taking the reins, and that's at least true for right now. That can change. And we've talked in prior months about the Chinese credit impulse data and the fact that China continues to try and cool their market and rein in lending conditions and things like that. They're continuing to do so. And in the past, that has had an impact on commodity prices. That has had a dampening impact to the price of commodities. I tend to think that they still will have that impact on commodity prices because just they're such a large player that they're able to have that impact. But in the short term, there's been so much money printed here within North America. We've got the excitement around the infrastructure plan. North America is running very strong and much stronger than every other region of the world. So if there is excess metal in Europe or Asia or Turkey or anything like that, there's a home. There can be a home for it here.
Okay, I was just kidding. This is the last question now. One just kind of came in under the wire. I think it's a really good one here. How have copper movements led or lagged carbon steel historically? Should we be aware of that?
I would say at least in this cycle, copper has led both on the upside and we'll see on the downside. But generally, copper, they call it Dr. Copper because it has a degree in economics, is what they say. Copper tends to be a good proxy for infrastructure demand, the power grid. It tends to be a good barometer for just all things metal. So it should have a lot of correlations to the rest of the complex, whether it's aluminum, nickel, stainless, or even carbon. And when China perked up in April, May of last year, copper caught a bid. Copper led us out of the charge. Copper admittedly did peak out in the last 30 to 45 days, and it is now off about 15%. So, we did hit record high prices in a similar fashion that we hit record high prices within carbon. I don't know for sure whether or not copper coming off is going to be a barometer for steel coming off, because obviously the supply demand dynamics can be different, but that could certainly, I tend to be of the belief that all of these industrial metals, at least to some capacity, have an intercorrelation to one another because they generally go into the same end markets.
Great. Great. So as a reminder to the audience, we do this the first Thursday of every month. I'm going to turn it over to Smarter Mike Carrazzo for the wrap up here. But I just want to remind everyone we are going to have this recording posted by early next week, and want to wish Happy Canada Day to all of our Canadian participants. Happy 4th of July coming up. But over to you, Nick, for a final word.
Yeah, no, really appreciate everybody's time. And again, sincerely apologize. We were having a tech issue with regards to our Zoom meeting. So apologies on that. We will not let it happen again. But there's a ton going on in the markets. And I think we're getting into some pretty exciting, I call it exciting, interesting, complex territory where depending on the commodity, we're starting to see some deviations between them. And I think that's when things get really interesting, because you kind of have to put your big boy hat on and actually do your independent research depending on the metal. It's not just rising tide lifts all boats or the opposite. We're starting to see things going in different directions. So to the extent we can be helpful in providing through, updated information, hop on additional calls. We're obviously getting fairly close into contract season and things like that for discussing 2022. So stay very close to your salespeople, stay very close to our procurement team and our risk management team. And we hope we can be of assistance in the coming months. But hope everybody has a great holiday, and we will be talking very soon.
Thank you.
Thanks.